Choosing where to put your money is one of the biggest financial decisions you will make. Every rupee you invest has a job to do. It can grow, sit idle, or lose value. The vehicle you pick shapes that outcome. Mutual funds and ETFs are two popular options in India right now. They look similar on the surface, but they behave very differently when you trade, pay fees, or plan for long-term goals. That difference changes returns, taxes, and your day-to-day convenience. So understanding the gap is not optional. It is essential to reaching your goals. Investing feels complicated to many people. Jargon piles up fast. NAV, SIPE, DMAT, expense ratio, it all overwhelms. That is why this guide uses plain language. No acronyms without an explanation. No hidden assumptions about prior knowledge. You will get practical clarity. You will also get scenarios that are easy to relate to. These will help you decide, not confuse you further. This guide will answer one clear question. Which is right for you? Mutual funds or ETFs? The answer is not one size fits all. It depends on your time horizon. It depends on cost sensitivity. It depends on comfort with trading, automatic monthly investing, intraday market access, fund manager picking stocks for you, low-cost index approach. By the end, you will know the trade-offs. You will get a simple side-by-side comparison. Management style, costs, liquidity, minimums, ease of use. I will give clear rules of thumb for different investor types. Young savers, busy professionals, active traders, low-cost seekers. I will also show how to combine both vehicles effectively. Finally, I will keep the tone direct and civil. Short sentences, clear examples, no fluff. If you want deeper detail, later sections will expand each point with charts and simple math. A mutual fund is best thought of as a big basket. Many investors put money into that basket. A professional manager then decides what goes into the basket. The manager can buy stocks. The manager can buy bonds. The manager can buy other assets. This pooling lets small investors access a diversified portfolio. Diversification reduces the risk of putting all money into one stock. Mutual funds come in two main flavors, active and passive. Active funds try to beat the market. Passive funds track an index. When you invest, you buy units of the fund. The price you pay is based on the fund's NAV. NAV stands for net asset value. NAV is calculated once a day after markets close, so you can buy or sell mutual fund units only at that daily NAV. That rule creates a simple rhythm. You do not need to watch the market all day. This makes mutual funds friendly for beginners. They are ideal for SIPs, systematic investment plans. SIPs let you invest a fixed sum every month. SIPs build discipline and help with rupee cost averaging. You can start a SIP with as little as rupees 500 in many schemes. An ETF, or exchange-traded fund, is also a basket. The key difference is that an ETF trades on the stock exchange. An ETF unit behaves like a share. You can buy it during market hours, or sell it during market hours. The price moves in real time, just like any stock price. Most ETFs track an index, Nifty 50, Sensex. That means they aim to mirror the performance of that index. ETF managers mostly rebalance to match the index composition. Because ETFs trade intraday, they offer flexibility. You can enter positions quickly or exit positions quickly. This is useful for cost-sensitive investors. This is useful for tactical investors. ETFs typically have lower expense ratios than active mutual funds. Low fees mean more of the market return stays in your pocket. But trading ETFs requires a DMAT account and a broker. Not all ETFs have high liquidity, so spreads can widen for some. That can add implicit trading costs. ETFs are transparent. Their holdings are often published daily. You know exactly which stocks are in the ETF and in what proportion. Active versus passive is the first big split. Mutual funds can be active or passive. Active funds employ managers who pick stocks. The manager's job is to beat the benchmark. That takes research and frequent decision-making. This work costs money. Expense ratios for active equity funds in India often sit between 1% and 2.5%, or even higher for niche strategies. Those fees come out of your returns every year. ETFs are mostly passive. Many ETFs simply track an index. There is no daily stock-picking team for a passive ETF. That simplicity lowers operating costs. Expense ratios for Indian ETFs can be as low as 0.05% to 0.5% for common index funds. Lower fees mean you keep more of the market return over time. For long holding periods, small fee differences compound significantly. Higher fees do not always buy higher returns. Active managers sometimes beat the index. Often they do not. Outperformance can be sporadic and sector-dependent. When an active fund underperforms after fees, investors lose the gap. ETFs deliver index returns minus a small fee and trading friction. That makes outcomes more predictable. Beyond expense ratios, there are hidden costs. Mutual fund exit loads, ETF brokerage costs, bid-ask spreads, demat charges. Trading cadence differs sharply between the two. Mutual funds transact at the end of day NAV. You place an order and it executes once daily. That creates a simple rhythm and reduces intraday stress. It also removes the ability to time trades during the day. This is convenient for SIPs and monthly planners. ETFs trade like stocks during market hours. You can buy anytime the market is open. You can sell anytime the market is open. That offers intraday flexibility and tactical options. You can use limit orders and stop losses. This helps active traders but also invites overtrading for inexperienced investors. Minimum investment rules are practical differences to note. Mutual funds let you start SIPs with small sums. Many AMC schemes accept 500 rupees or even less per month. ETFs require you to buy whole units, at least one share price. This can raise the entry barrier for some small savers. Ease of access tilts toward mutual funds for many retail investors. You do not need a demat account to buy most mutual funds. KYC is usually enough. A bank mandate is usually enough. SIPs automate investing each month. This simplicity helps busy people stay consistent. ETFs require a demat account and brokerage account. You need basic knowledge of order types and execution. Some brokers now offer micro-SIP-like plans for ETFs, reducing friction but adding platform complexity. Tax treatment and timing can change decisions. Equity mutual funds and ETFs follow the same capital gains rules. However, trading frequency in ETFs can create short-term gains taxed at higher rates. Finally, match the choice to the goal. For disciplined monthly saving, mutual funds win for most people. For low-cost index exposure, ETFs excel. Mutual funds make investing easy for most people. You can start a SIPP with as little as Rs 500. The AMC handles research, trading, and paperwork for you. That removes friction and keeps investing disciplined. Professional managers can add value in niche segments and volatile markets. ETFs shine on cost and transparency. Most ETFs charge very low expense ratios. Over years, low fees compound into meaningful savings. ETFs disclose holdings frequently, often daily. That transparency reduces surprise risk. Mutual funds have clear cost drawbacks. Active funds often charge 1% to 2.5% or more in expense ratio. High fees eat into long-term returns. Many active funds fail to beat their benchmark after fees. ETFs are not free of problems either. Require a demat, broker access needed, low trading volume, wide bid-ask spreads, implicit trading costs when you buy or sell. ETFs historically lacked easy SIP formats, though brokers are changing that. Neither guarantees returns or protects against a bear market. Behavioral risk remains large. Switching after losses and chasing hot products often harms returns. For a young salaried investor who wants simplicity, mutual fund SIPs usually win. Low entry, automation, goal-oriented tools fit a busy life. Over decades, consistent SIPs in broad equity funds can build substantial corpus. If you prefer forget and grow, mutual funds reduce decision fatigue. If you are cost-sensitive and comfortable with trading, ETFs are compelling. A low-cost Nifty or Sensex ETF keeps fees minimal. When markets dip, buy ETFs intraday and take advantage of price moves. Consider a hybrid example. Core ETF for broad index exposure. Satellite active mutual funds for specific themes. This combines low-cost core with targeted active bets. The core ETF reduces long-term fee drag, while active satellites aim for higher returns. In the end, pros and cons point to fit, not dogma. Ask what matters. Convenience, cost, control, tax timing. Match the instrument to that priority and your ability to execute. Most investors do well with a simple plan and disciplined execution. Pick a path, mutual fund SIPs, ETFs, or a blend, and stick to it through good and bad markets. For the beginner and the busy saver. If you are just starting your investment journey, the choice can seem daunting. For most beginners and those with a busy schedule, mutual funds offer a smoother, more guided path. The biggest advantage is the ease of starting a systematic investment plan or SIP. With a SIP, you can automate your investments. You put a fixed amount into a fund every month. This removes the need to time the market. It builds a disciplined saving habit. For the cost-conscious and trading-savvy investor, if you keep a close eye on costs and feel comfortable navigating the stock market, ETFs present a compelling case. The biggest advantage: remarkably low cost. Most ETFs are passively managed and simply track an index like Nifty 50 or Sensex. They don't require expensive research analysts or fund managers. This means much lower expense ratios. Over 10, 20, 30 years, the cost difference can compound into substantial savings. The balanced approach, using both for optimal results. You do not have to choose just one. A balanced hybrid approach allows you to build a robust portfolio that is both convenient and cost-effective. This strategy is often referred to as a core and satellite model. Use broad market ETFs for your core holdings and actively managed mutual funds for satellite positions. Key takeaways and next steps. Investing is simple in idea but varied in execution. Mutual funds and ETFs both pool money to give you diversification. They differ in cost, control, and convenience. Mutual funds excel at SIPs and suit hands-off investors. ETFs excel at low fees and offer intraday control. Your personal goals decide the better fit. Time horizon matters. Tax view matters. Tolerance for trading matters. The right choice is the one you can stick with consistently. Keep the core principles in mind as you decide. Lower fees compound into meaningful differences over years. Automated SIPs build discipline and remove timing stress. ETFs give precise market exposure and let you act on opportunities. Neither instrument guarantees returns. Both require a plan and patience to work well. Start simple and build slowly as you learn. Put a clear plan into action today. If you are a beginner, start a mutual fund SIP and learn the basics. If you are cost-focused and comfortable with trading, begin with a low-cost ETF core. Consider a blended approach. ETFs for the core, mutual funds for satellites. Rebalance annually and keep fees and taxes in check. Finally, stay consistent and avoid noise. Markets will wobble, your plan should not. Track progress against goals, not daily prices. Ask questions when unsure and seek simple, evidence-based advice. Pick a path, commit, and let time do the heavy lifting.